This is the Unit 3 AP Microeconomics review. So the first thing we're going to talk about in Unit 3 was measuring cost and profit in terms of accountants and economists. So first let's talk about costs. There are two types of costs we need to think about. A firm's explicit costs. Now these are just normal resource costs. So if you have to pay rent on a building, it's a normal resource cost that you're paying to use it, or your workers' wages, the resources used to make the product. Implicit costs are a little bit different. These go into the opportunity cost we've been talking about since Unit 1, the next best alternative. So what we gave up in order to be in the industry we're currently at. So there are foregone opportunities. So if I leave my job and start up a new company, my old income is an implicit cost because it's what I would have been making if I wasn't at the new job. Or if I was previously collecting interest on a bond at an annual rate, but I had to cash it in to start my new business, the interest I could have collected on that would be an implicit cost because I'm no longer collecting that revenue because I sold it and now I'm using it for something else. So implicit are opportunity costs. Now why these are significant is accountants and economists look at costs differently. Accountants only measure explicit costs. So if we are going to measure a firm's accounting profit, we only need to look at the total revenue for a firm minus their explicit costs. So this just shows how in this one industry, how is this entrepreneur doing? How is this business doing? It doesn't take into account, are they losing out by not doing something else with their time, with their money, with their resources? Economists do think about this though. So if we are going to measure economic profit, we look at our total revenue minus our explicit and implicit costs. We need to take both of those into consideration with economic profit. So with this, if we're making positive economic profit, it means that we are making not only revenue, but revenue minus our explicit costs, our normal resources, and we're making more money than if we had been in another industry. The minimum we should be willing to make in terms of profit and stay in an industry is what's known as our normal profit. So normal profit is that break-even point when you are making zero economic profit. Why this is okay? If I'm making zero economic profit, I am still making positive accounting profit. So I have no incentive to switch to another industry. I'm just going to stay where I'm at. So this is the minimum I need to break even to where I'm not tempted to leave and go to another industry where I could potentially be making more money. The first graph we learned in this unit looks at 3 lines. And it's easier to draw it in 2 separate graphs because really you're going to be analyzing what these lines mean more than drawing it on the FRQ portion of the AP exam. So if we break it into one for the total product line, total product is the total amount we're producing as we add more resources, in this case labor. And then another graph for the average and marginal product. Average product is the average as I add more labor that the workers are contributing. And marginal is how much each additional worker is contributing. So we can look at these scenarios on this graph. The first example is called increasing marginal returns. This is where each new unit of labor is bringing in a larger quantity than the previous. So that's why my marginal product is increasing and my total product is increasing at a steep rate. And average is increasing as well there. Then we have diminishing returns. This is the one we'll see pop up the most because this ends up describing a lot of the lines that we're going to be using for the rest of the semester. So diminishing marginal returns, also known as diminishing marginal product, looks at how after a point when you start adding workers, each worker contributes less and less, which total product is still increasing because they're still increasing the total amount the business is receiving, but at a decreasing rate. So we can see that right here. My total product is increasing, but at a decreasing rate, and then it eventually even begins to plateau. My marginal product is now going down, and I'm experiencing this all the way to where my marginal product intersects with 0. And then the last stage is negative marginal returns, which, like it sounds, is where marginal product becomes negative because the workers are overcrowded, too many cooks in the kitchen, they start contributing to the point where it hurts the business. And this is where total product starts to decline. So the peak of total product is when marginal product is at 0. That's the highest point, because after that, it actually starts to decrease total product when we get into the negative marginal returns. Its mirror image is the cost graph. Product is the mirror image of the cost graph. So instead of marginal product, we're going to be looking at marginal cost. This line right there. So instead of looking at marginal product, we're really going to be focusing on marginal cost. But since they're the mirror image of one another, it still describes the 3 stages of increasing, diminishing, and negative marginal returns. It's just the exact opposite. So when marginal product is going up, marginal cost is going down, and then when marginal product starts to go down, marginal cost starts to rise, illustrating again diminishing marginal returns. We also have our average total cost and our average variable cost. Our average total cost is the line that we're going to be using a lot in this unit and future units as well. Average variable cost is really used to show if a firm should stay in business and keep producing even if they're producing at a loss, or if they should shut down. That price at average variable cost, if it's above average variable cost, a firm will continue to operate but at a loss. But the minute it hits it, that's its shutdown price. Because if your price falls below your variable cost, you don't have incentive to be in the industry. You are going to shut down below that point. But other than shut down, and to show where average fixed cost, average variable cost isn't as important as average total. Average fixed cost, which average variable plus average fixed equals average total, can be drawn as a decreasing line because our fixed costs start to decrease as the output increases, because it's costs that don't change no matter what quantity I produce. The average of them falls as the output increases. But I don't have to draw this line on the graph. If I note that it's always going to be the difference between my average total and average variable cost line. So a lot of times they don't have you draw this on the AP exam because you know it's the difference between the average total and the average variable cost. The average total cost is going to be one of the most important lines. We're going to use it to measure profit, loss, and breaking even in the short run for a firm, and then it actually makes up the entire long run for a firm. Let's look at the long run first. So when we think of long run, we think of 3 different stages a market can be in, where if you expand the number of firms, it may push us into one of the different stages. The 3 stages are economics of scale. This is the downward sloping portion of the long run ATC, that as I'm increasing production, my costs are falling. So as output rises, my costs are falling. So firms are going to continue to produce at economics of scale because their costs are falling as they increase their output. Then we have our next stage where long run ATC is at a minimum. This is known as constant returns to scale. This is the ideal point for a firm because costs are minimized as output increases. So you are at the minimum of the ATC, and that is a goal, to be at the minimum of the ATC because we want our costs to be minimized. Then the third stage is when a firm starts to overproduce, build too many factories to where it can't efficiently control them. And so at that point, if a firm grows too large, the costs start to rise as the output rises. That's known as diseconomics of scale. So if costs rise as output rises, it's diseconomics of scale. If costs are minimized as output rises, it's constant returns to scale, and if costs fall as output rises, that's economics of scale. And that's all we look at for the long run, is that one long run ATC line, and we look at, is it in the downward economics of scale portion, the minimum constant returns, or the upward diseconomics of scale portion. But then we can also use the short run average total cost to measure how an individual firm is doing in what's known as a perfectly competitive market. So perfect competition is the first of the 4 market structures we're going to be covering for the rest of the semester. This is also the one with supply and demand we've been assuming firms have been in since the beginning of this class. So we've been assuming all firms are what's known as price takers, where wherever supply and demand is, that equilibrium price determines the price for the firm. And in this market, there are tons of sellers, so they have no individual control over the price. There's also tons of buyers, consumers as well as are price takers. They don't have a say in whether or not they pay a higher or lower price. So since they have to take whatever price the market determines, our price is also equal to our demand in a perfectly competitive market. Also in a perfectly competitive market, there are a ton of firms selling almost identical products. So there's no product differences that separate style or brand or quality. They are pretty much identical, which means it's not super realistic in our modern world. And they have, again, no control over price. So tons of producers selling identical products at identical prices. Pretty idealistic. So the supply and demand graph we've been drawing all along isn't as realistic when you look at the market that participates in. So our graph for perfect competition is using the same setup as our cost of production graph. We still have our ATC, our AVC, and our marginal cost line. Again, AVC is used to determine shutdown price. So if price falls below where it intersects AVC, we have to shut down. There's no incentive to keep going. And if price is above AVC but below average total cost, a firm will continue to operate but at a loss. If price is equal to average total cost, this is known as that break even, that normal profit point where it intersects the minimum VATC. That's the goal, and actually in perfect competition, that's where firms always end up in the long run, which we'll get to in a moment. And then if price is above average total cost, that means a firm is making a profit. So how I would measure profit or loss, because a lot of times on the AP exam it asks you to actually shade the profit or the loss, is I look at where that price is. So for example, if my price is right here and I am making a profit because it's above ATC, the first thing I'm going to do is figure out my profit maximizing quantity. A profit maximizing quantity for a firm is where marginal revenue equals marginal cost. So I'm always using this to determine at what quantity I should produce at. Now, this may be at a loss or break even or at a profit. This just determines the quantity this perfectly competitive firm is going to produce at. So at the point where the price is above ATC, right here, my price in perfect competition is equal to my marginal revenue, my average revenue, and as I already mentioned, my demand, because they're price takers. So actually, in perfect competition, my marginal revenue equaling marginal cost is the same point as where price intersects with marginal cost. And that would be my profit maximizing quantity for the firm, this down here. So I'm going to put that as QF. Then I can measure the profit. So I take the price that I'm at the profit maximizing quantity, I go down to where that point intersects the average total cost line and then over. And that area, that rectangle, is the amount of profit a firm is making. So that's how I measure profit. If a firm is operating at a loss, which we see at this price below, we can do the same exact thing. It still is measured by the difference between the price and the average total cost. So if we're operating at a loss, here's where I am. Here is where price equals marginal revenue equals marginal cost, and this would be my profit maximizing quantity here. I'll label as QF. I would go up again to where that point intersects with average total cost and over, and that rectangle would be my loss. So whether a profit or a loss, you're always measuring it by where the price compares to the average total cost line. And you can use that to shade in your profit or loss for a firm. So one thing we look at is how changes in the market affect the individual firm. So I said a moment ago, perfectly competitive markets are completely dependent on what the market equilibrium is. So that's our normal supply and demand graph. That's the graph for the market or the industry. So firms within that industry are tied to whatever happens there. So I have my market graph set up next to my firm's graph to show that the price equilibrium determines is the price the firm has to charge as a price taker. But when things change in the market, which go back to shifts in supply and demand we've been doing since Unit 1, that will change the equilibrium price and also change how the individual firm is doing. So let's say, for example, that technology increases in the market for cell phones. We're going to show how that affects the individual firms that sell cell phones as well on the graph. So, new technology is the T in gross and moves supply and increase to the right. And that would lower equilibrium market price, which would move across to actually lower the price for the individual firm as well. So my equilibrium market price is lower and my equilibrium market quantity is greater for the market. But in the firm, now my quantity is still where marginal revenue equals marginal cost, which is where price equals marginal cost. Now the quantity the firm is producing is less than it was before. Because if they're selling at a lower price, they're going to sell a lower quantity. So we see how the market shifts in price affect the firm's price, and now they're making a loss. And how much loss? Again, we take the quantity up to ATC and over. This would be how much loss this firm is incurring. So we can show how market shifts affect the firm's graph. But one thing in perfect competition, we assume firms always come back to long-run equilibrium. Because in the market, if firms hear they can make a profit in an industry, they're going to enter into that industry, bringing it back to long-run equilibrium. Or if firms hear they're making a loss, they're now going to leave the industry, exit the industry. This process of exit and entry of firms is what will always drive our firm back to long-run equilibrium, which is when price is at the minimum of the ATC. So let's show this on a new example. Let's show this on an example of a firm making profits, driving more firms to enter into the market in the long run. So we'll say the demand for a product increases, which drives up the equilibrium price, and for the firm, drives the firm's quantity up, and drives also the market equilibrium quantity up and the price up for both the market and the firm. So other firms are going to hear, ooh, I can make profit if I enter into this industry. Because what we see is that the price now, it's above ATC, so this firm is making profit. But it won't last. It's only short-run profits, because as more firms enter into the industry, what's going to happen in the long run is that's going to increase the supply in the market. And by increasing the supply in the market, it's actually going to move equilibrium price back down to that long-run equilibrium again. And so we end where we started in long-run equilibrium, breaking even. And that is also where we label our normal profit. It's that break-even point right here where I am not making any economic profit. However, I am making positive accounting profit, so I have no incentive to leave the industry. I'm breaking even. This is also at long-run equilibrium, in perfect competition, the point where firms are both allocative and productively efficient, which you need to know productive efficiency is the minimum of the ATC, which we see at long-run equilibrium, we are at the minimum of the ATC. So we are productively efficient. And you also need to know that in long-run equilibrium, in perfect competition, firms are also allocative efficient, where price is equal to marginal cost. You don't need to only know that that occurs in long-run equilibrium. You need to remember those two efficiencies as well. Which one is marginal cost and which one is minimum of the ATC. So make sure you study that, because those are super easy to mess up. So perfect competition is the only of the four market structures that we're going to cover that is both allocative and productive efficient in long-run equilibrium. Price is equal to the minimum of the ATC, productive efficient, and price is equal to marginal cost, allocative efficient. So it is the only market structure that is truly efficient in all the ones we're going to cover, which is why it's ideal and the one we've been looking at with market all along. So we only have one more thing to cover. This is the tricky part of perfect competition. We need to look at constant versus increasing cost industries. What I just did, moving back by an equal amount to long-run equilibrium, is assuming this is a constant cost industry. Most of them are, and it'll usually either say constant cost, or if it doesn't say either, then you can usually assume constant cost, and the supply will move all the way back to long-run equilibrium as more firms enter into the market. However, if it says it's a increasing cost industry, this changes things in the long run. Not the short run, but the long run. So let's set up our graph and show the short run change, and then show how an increasing cost industry will change the final graph. When the demand increases, moves to the right, just like before, this drives the price up for the market and the firm. And you can actually, whenever you're listing price in perfect competition, there are 4 total things you can list them as: demand, marginal revenue, average revenue, and price. Mr. DARP is an easy way to remember that. So all of those things represent price, and now that prices are higher, this individual firm is making a profit, just like before. But what changes in an increasing cost industry? That as the equilibrium market price goes up in an increasing cost industry, so do the resource costs for the firm. It becomes difficult for bidding for resources to occur when the prices of the goods are more expensive. The resources then become more expensive as well. So how this affects the graph in the long run is supply is still going to increase because firms are still going to enter into the industry with the desire of making the profit, but it's not going to increase by as much as in a constant cost industry. So it'll increase by just a little, and the trick is it has to increase by less than the demand increased. So let's show that. Supply increases by less than the demand increased, which means my price at my new equilibrium is not all the way back down to where it was originally, like in a constant cost industry. It's a little bit above because not as many firms are able to enter into the market at the higher resource costs. And since resource costs are higher, we have to do one additional thing because we're still going to end up in long-run equilibrium. But to do that, we have to show the increase in resource costs by the ATC line moving up to create a new long-run equilibrium. So let's show that. So now my ATC line will increase to where I am still at long-run equilibrium and price is at the minimum of the ATC, but it's a new long-run equilibrium that's higher than the original. So to summarize, if it says increasing cost industry, be very careful in the prompts to read it closely to see does it say constant or increasing. And if it says increasing cost industry, in the short run when a firm makes profits because the demand increased, it also increases the resource costs for the firm, which means not as many new firms can enter into the industry. So supply will increase, but not as much as the demand increased. Meaning that our new equilibrium is between the original lower one and the demand increase one. It's in the middle. But it'll still end up in long-run equilibrium. Because of the increased resource costs, also what will happen is the average total cost line will increase to meet at this new price. So that average total cost increases. So it'll also end up in between the original low long-run equilibrium and the point where the short-run profits are. So the quantity at the new long-run equilibrium will be greater than the original firm's equilibrium quantity, but less than when the demand increased. And price will be greater than the original firm's long-run equilibrium, but less than the equilibrium price when the demand increased. So it'll just create this kind of middle new long-run equilibrium. And that is the end of our Unit 3 AP Microeconomics review.